But I think the fact that gold moved back so rapidly just tells us two things. First of all, it tells us there were a lot of people who missed buying gold on the way up, so this was an opportunity to get back in. And the other thing, frankly, it tells us is that the reasons that people have been buying gold for the last 2 years have not gone away. And for Western investors who are worried about whose concern is lower interest rates before we've quashed inflation, I don't think one can honestly say, however optimistic you are about President Trump's program, I don't think we can say that at least in the near term, those concerns are no longer valid. You can't say they're no longer valid. So I think the reasons to buy gold still remain.
The election-induced selling occurred during the subdued central bank and Chinese buying of gold. After surging 72% from its low 2 years ago, a less than 10% pullback represents a modest correction. Similarly, gold experienced a decline following Trump's victory in 2016, but that downturn lasted just over a month before a robust recovery took hold. If history is any guide, this current pullback may already be halfway through its course. Adrian Day of Adrian Day Asset Management examined gold's price action following the U.S. election, observing that while gold swiftly recovered from its initial pullback, a second leg down could still occur. He highlights that the recent strong rebound indicates many investors who previously missed buying opportunities are now eager to re-enter the market. Uncertainty surrounding the potential impact of President-elect Donald Trump's policies on key economic sectors has cast doubt on a December rate cut. According to the CME Group's FedWatch gauge, the likelihood of the Federal Reserve lowering its benchmark rate during the December 17th and 18th meeting has dropped to 56%, down from 75% just a month ago. Additionally, a stronger dollar continues to weigh on gold, reducing its appeal by making it more expensive for investors holding other currencies. Adrian Day emphasizes that gold is not a political asset but an anti-fiat metal, underscoring its importance as a hedge. He asserts that the demand for gold as a protective asset will likely remain strong over the next 2 to 3 years. While a strong dollar may appear to be a headwind for gold, Day points out that the dollar has lost 24% of its purchasing power over the past 4 years, according to government data, further justifying the case for owning gold. Let's delve into the video to gain further insights. Before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
As you know, the Western investor, particularly the retail investor, was only just beginning to move back into gold, right? We all know that, but I think it's worth repeating so it sets the scene. People were only just beginning to get in. When Trump won the election and won it convincingly, then people think you're going to have a stronger economy, which is good for the dollar, which is weak for gold. People think perhaps with Elon Musk and Vivek Ramaswamy, they'll cut the debt, which means, if the debt's lower, that's bad for gold. There's also some economists who think that Trump's program is inflationary, so that will mean that the Fed will cut rates slower. So if the Fed cuts rates slower amid a strong economy, that's obviously a bad environment for gold. So it wasn't illogical. I don't think it was just a knee-jerk reaction. It wasn't illogical to say, gold will come down. The rebound has been very, very powerful. I mean, to be honest, I hate to say this, don't anyone shoot me, but I would have rather, if we were going to have a correction, I would have rather seen gold go down to where there's some strong support, like the 2,500, 2,520 level, and sort of churn around there for a few weeks. That's always get a cleanse, if you like, before moving back up. But I think the fact that gold moved back so rapidly just tells us two things. First of all, it tells us there were a lot of people who missed buying gold on the way up, so this was an opportunity to get back in. And the other thing, frankly, it tells us is that the reasons that people have been buying gold for the last 2 years have not gone away. Central banks who were buying gold in 22, 23, and all this year, but declining in August, September. Central banks who are buying gold who are worried about the weaponization of a dollar. Trump's election doesn't do anything to say that's not an issue anymore. Chinese investors who are worried about their economy and their banking system, well, that doesn't change it. And for Western investors who are worried about, whose concern is lower interest rates before we've quashed inflation, I don't think one can honestly say, however optimistic you are about President Trump's program, I don't think we can say that at least in the near term, those concerns are no longer valid. You can't say they're no longer valid. So I think the reasons to buy gold still remain. A lot of people forget that, there's a long, more than 2 months gap between the election and the president taking office. Yeah, I mean, if we get another pullback to 2,500, it'll probably stay longer, just because it's rebounded now. It goes down again. It will stay there longer, but that wouldn't concern me at all, to be honest. I just can't see us going much under 2,500. And again, the reasons to buy gold remain. Even if you take an optimistic view on what Trump might do, even if you take an optimistic case of, let's say, what Elon Musk and Vivek Ramaswamy are going to do with cutting waste from a budget, and my goodness, is there a lot of waste that they can cut without even touching programs. That's the thing a lot of people miss. They say there's no way they can do it because you can't cut interest, you can't cut defense, you can't cut entitlements. But that's not the point, although frankly I think they need to reform entitlements. But that's not the point. The point is eliminating the fraud, the duplication, and the waste. And there's a lot of that. But even if they're truly successful, it's not going to be for 2, 3, or probably 4 years before the impact of that is obvious to people. If you lay people off, most of the government employees, if you lay them off, they have a 1-year severance. So even if you laid off 30% of the workforce, you're not reducing anything for a year. That's just one example. So these things will just take time, however successful they are in the end, and I wish them well. So the need for gold over the next 2-3 years hasn't changed. But I mean, gold is not a political metal. Gold to me is the anti-fiat metal, if you want. And obviously a strong dollar, strong against other currencies, is negative for gold. But you can have a strong dollar and still be losing purchasing power. The dollar's lost 24% of its purchasing power in the last 4 years. That's by the government's own, 22%, sorry. That's by the government's own numbers. So, that in itself tells you, if it's losing purchasing power, that tells you need it. You need gold.
The U.S. dollar index is consolidating, enhancing gold's attractiveness to international buyers. Gold prices exhibit significant volatility, prompting speculation about whether the precious metal can reach the much-anticipated $3,000 mark. On the macroeconomic front, gold prices are bolstered by a weakening U.S. dollar and mixed signals from the Federal Reserve. Although the $3,000 milestone remains out of reach for now, geopolitical tensions and the dollar's decline could act as catalysts for gold's next major rally. Gold remains a compelling option for investors, offering a balance of risks alongside its established safe haven appeal. Adrian Day highlighted gold's remarkable 72% surge over the past 2 years, noting that the recent 7% pullback only brought prices back to levels seen 5 weeks earlier. He suggested that if another decline occurs, gold could retest the $2,500 level and consolidate there for several weeks. Additionally, Day emphasized the strong performance of the gold sector, pointing out that it currently leads all U.S. sectors in cash flow growth this year. Now, let's redirect our attention to a video.
I am a little conflicted about the immediate term because the pullback we had in gold was so short and so shallow. So when you think that gold went up 72% over 2 years and the best it can do in a correction, when something dramatic has changed, or but the perception is dramatic, and the most it can do is a 7% correction and take us back to where we were 5 weeks before, that's not a correction. So I'm a little bit concerned we might see a second leg down, but would always be spookier than the first leg down, right? Because when you get a recovery, the sentiment is, oh, well, that's it. We've beaten that one. And then if it falls again, I wouldn't be surprised if we get back to the 2,500 level. And if we do, we'll probably shuffle around there for, 4, 5, 6 weeks, perhaps. To me, that would be exceptionally healthy. If we do get that, that would be very, very healthy. But I would say to anyone, certainly if they're not invested in gold, don't wait for that. The key is that the reasons to buy gold have not changed. And we still need gold for a lot of reasons. And so, yeah, I wouldn't wait for, if you're underweight, I would definitely pick up the buying. So we've now had 3 back-to-back quarters, 3 consecutive quarters of increasing cash flow. And you would expect it with the gold price moving up, of course. It's actually the gold sector is the sector with the fastest growing cash flow of any sector in the U.S. this year. So you would think that would begin to get people's attention. I think the problem was, of course, most companies didn't report until the end of October, and a week later, the gold price fell. So that kind of knocked the wind out of that a little bit. But I think, and again, if we can end the year, so that'll be a full year with rising cash flow, I think that'll be very, very positive. Because when people do their year-end rebalancing, it might be individuals, it might be money managers. You do a year-end, a lot of people look at it at the end of the year, do a year-end rebalancing. Same in mutual funds, you go to the board and you present. We may have talked about this before, and someone will say, where's the gold? Don't we have any gold? It's doing well. And, so I think if we can have a fourth quarter, so that'll be 4 consecutive numbers, but importantly, the year-end numbers good, even Barrick is promising us that they will meet their guidance with a very, very strong fourth quarter. We'll see. But in aggregate, I think the companies will be doing well in the fourth quarter.
Gold is traditionally viewed as a safe investment during economic and geopolitical uncertainty, such as trade wars. President Trump's promise of significant tariffs on Canada, Mexico, and China remains a key concern. While these tariffs could trigger trade wars and increase gold's appeal, the inflation risks they introduce might limit the Federal Reserve's ability to cut rates, potentially exerting downward pressure on gold prices. With the markets now awaiting the release of the Fed's November meeting minutes, the probability of a December rate cut stands at 56%, leaving investors cautious and watchful. What is your stance? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up and remember to subscribe to stay updated. Thank you for being a part of this journey with us.